Pause, pivot, or hike? What is the Fed's next move, and what are the implications for metals and the markets at large? I discuss with Brien Lundin of the Gold Newsletter on today's show.
Welcome to Inside the Vault with SWP. Join Mark Yaxley as we explore the latest news, reports, and some bullion basics for investors old and new. Let's get to it.
Hello, everyone, and welcome back to Inside the Vault with SWP, a weekly show where we dive into the world of precious metals with the brightest minds in the space. If you're new to the show, you can find all of our previous episodes posted on the Strategic Wealth Preservation YouTube channel, along with tons of other educational content on the world of precious metals investing. While you're there, do us a favor, like, subscribe, leave a comment on our videos. Your viewership and support goes a long way to helping us grow this channel and help to educate other metals investors worldwide. I'm your host, Jeremy Varlow. Today on the show, as I mentioned, we have Brien Lundin of the Gold Newsletter, a leading publication in the metal space. Brien will be with us very shortly, but let's check in with CEO of SWP, Mark Yaxley, for his weekly market update. Mark?
Thanks, Jeremy. Great to have Brien on the show today. He's a true veteran of the precious metal space, and no better time to have a guy like him on to share his thoughts about gold and silver. As you know, I've been a little bit under the weather this week, so I'm filming from home today. But I'll tell you who hasn't been under the weather, and that's been gold and silver. They are absolutely tearing it up this week. Both metals are shining brightly in 2024. The price of gold has increased now by over $300 an ounce since the beginning of the year. That's 15%. And silver has experienced an impressive 20% jump. This significant growth has not only captivated the investment world, but has also prompted analysts to predict further gains for both metals in the coming months. These two metals are really starting to gain momentum, and the world is paying attention. A notable aspect of this recent rally is that gold and silver are rising despite a strong US dollar. And right now, the US dollar is trading at about 106 on the Dixie, which is very, very high. If you pay attention to the Dixie, which is an important index, you'll note that the dollar is really strong right now, coming off the back of higher than anticipated US economic data that came out this week. Gold and the US dollar have a long established inverse relationship, meaning that the strength of the dollar typically leads to weakness for the price of gold. That just hasn't been the case in this rally. Nothing seems to be able to slow gold and silver down at this point. Also of interest is that this rally has largely been fueled by Asian investors, particularly Chinese investors, who are shifting away from high-risk domestic real estate investments and moving some of their money into the gold market. According to the World Gold Council, consumer demand for gold in China increased by 16% in 2023, while demand for gold bars and coins rose by an impressive 27%. And I can tell you for a fact that that 27% increase in gold bars and coins is a direct indicator of retail investors buying precious metals in China. Meanwhile, North American investors have been enamored by AI stocks and by Bitcoin and have paid less attention to gold and silver recently. We've seen the trends in the ETFs. The investors in North America just have not stepped up to the plate the way investors in Asia have. However, this trend does seem to be changing as gold and silver have captured headlines across some of the major news publications in the US and in Canada, indicating that more dollars will be flowing into metals over the coming weeks. Geopolitical uncertainty remains high, Jeremy, with over 60 countries holding elections this year, including in the United States, of course. Additionally, conflicts in the Ukraine and Gaza persist, while Israeli Prime Minister Benjamin Netanyahu has vowed to continue to fight and eliminate Hamas, stating earlier this week that victory requires entry into Rafah and the elimination of the terrorist battalions there. It will happen. There is a date, end quote. So Netanyahu seems very determined to complete the campaign. Other leaders have expressed grave concerns that these actions will escalate regional tensions and cause severe loss of life. In fact, We've got the added possibility now of Iran and Israel entering their own separate conflict. There's been a lot of mud thrown back and forth between the two this week, and the U.S. has now stepped in and said that they will support Israel in that conflict should it materialize. So a lot of uncertainty on the geopolitical front, and obviously that is fueling gold and silver. And from a technical analysis perspective, gold has clearly broken through previous key resistance points. 2100 was one that gold fought and bumped up against for quite some time. And with mining production having flattened since 2020, analysts' predictions for gold reaching $24.50 an ounce and higher, silver as high as $32 an ounce, all now appear to be within reach. Back to you, Jeremy.
All right, thank you, Mark. Let's bring Brien into the conversation here. Brien Lundin is the executive editor of the Gold Newsletter, a leading publication covering precious metals, mining stocks, and the opportunities within the resource sector. Brien also hosts the New Orleans Investment Conference, which is an esteemed annual event that gathers industry experts and investors to discuss trends and strategies in the world of precious metals and beyond. Brien, welcome to the show.
Wonderful to be with you, Jeremy. Thank you so much for the opportunity.
Yeah, this is going to be fun. We're going to dig into things here right away. I want to start right out of the gate with something that's on everyone's mind. Mark touched on it a bit, inflation and interest rates. Just yesterday, we saw the new CPI data that inflation was higher than expected, which gave the markets a bit of a jolt, possibly derailing what everyone was expecting to be the first of a series of 3 rate cuts in June. I'm curious to get your thoughts on the current monetary policy out of the Fed. We've seen a few other countries issue their first rate cuts in recent weeks. You've been outspoken about the Fed needing to pivot for its own reasons. Do you think that's still on the table? Is it delayed or perhaps not at all?
Yeah, I think it's still on the table. I think it might be delayed a bit, although, the emotions run back and forth on that topic with regularity. And right now, it's looking more toward July, which may be the last opportunity that they have to without seeming political at all. September will probably be a bit too close to the elections. But yeah, they will have to cut. That is going to be a big driver for gold. We would have expected 3, 4, 5 months ago that driver, that factor would already be impacting the gold price at this point, and it's been pushed further and further back into the year. They will have to do it at some point, regardless of what's going on in the economy, because we have tremendous levels of interest rate resets coming due. It's the Federal Reserve. We're already paying over $1 trillion a year just in debt service costs because the size of the debt is so much larger today. And a lot of that debt was accumulated at very low, essentially zero-bound interest rate levels. So we're resetting at current rates, and the leverage to that, the torque on that is just tremendous as far as bottom line interest rate costs, our debt service costs. And that's just a small part of the picture. We have corporate debt that's resetting. We have commercial real estate debt that's resetting. And that's like a tsunami that's off the coast and about to crash onto the economy in the months ahead. And so they will have to pivot at some point. The most salient feature of this gold market, though, is how irrelevant these previously all-important factors are. You would think that the pivot being first pushed further and further back and essentially, out of direct sight at this point would have a very negative effect on the gold market. You would think that rising treasury yields would tampen down the gold price. You would think that the strong dollar index would hold gold back. And none of it's working right now to hold back this gold bull. We had the CPI number, as you mentioned, as we speak, came out yesterday, significantly hotter than anyone expected for the 3rd month in a row. So it's a trend now, and that's part of the story as well. And gold got knocked back immediately along with all the other markets, then fought back into the green. And as the day progressed, we saw for the first time that it actually ended up significantly lower on the day. But, you know, as we speak, it's bounced right back up. It's up considerably for no apparent reason, no precipitating factor, no big thing in the news driving it ahead, despite the fact that the dollar index is flat and treasury yields are up again, and yet gold's up strongly. So that's the big thing. And, you know, as before I came on with you, I was writing an alert to our readers, and the gist of it is that the most surprising part of this gold run is that it's so surprising. Everything about it is shocking. And there's something going on. We think we've kind of explained it, but there's more going on than I think we've been able to adequately explain at this point.
Yeah, it's really interesting. You said a few different things there, and they play really well into my follow-up questions. But one thing in particular, and we've had other interviewees on the show who've said the same thing. Like, if you looked at the interest rate environment over the last 2 years, you know, a lot of the other pundits that we've had on the show have said, I'd expect gold to be trading, you know, less than $2,000 right now, but it has fared quite well. And as a matter of fact, we had Brent Johnson on the show probably about a month or 6 weeks ago now, and we were talking about the relationship between dollar strength, treasury yields, and the price of gold. And, you know, as part of his overarching theory is he thinks at some point that is going to change, and that, you know, despite a strong dollar and high yields, gold will also run at the same time, which is kind of what we're seeing play out here a little bit. You know, like I said, gold performed relatively well in 2023. We've seen a great start to 2024. You know, do you think that this monetary policy, these decisions, will have too much of an impact on gold the rest of the year? What are your thoughts for gold for the rest of 2024?
Yeah, people forget that Brent is actually a gold bull. He takes a lot of heat for being a dollar bull, but he's maybe the only, or at least he was the first that could be both a dollar bull and a gold bull. And I think for all the right reasons. Yeah, monetary policy has driven all markets for, you know, 15 years now, or 14 years, somewhere along that, really since the great financial crisis. The markets have become totally addicted, not just to easy money, but to ever easier money. And all eyes look toward the Fed in every market. And this rising sea of liquidity, typically a rising sea of liquidity, has driven all markets, even those that traditionally have not been correlated, positively correlated, have driven them all higher, floated them all higher on the sea of liquidity. And as that sea of liquidity was withdrawn, and monetary policy tightened over the last 18 months or so, they've all gone down together or gone in the same direction together, depending on what the current market view is as far as upcoming Fed policy. So it is the all-important driver for all markets, because every asset class is just addicted to that flow of monetary liquidity now. That said, literally over the past 6 weeks or so, we are seeing something very different happen or develop for gold. It has evolved that gold is ignoring these monetary policy signals, and it is rising strongly. Now, we've credited a good bit of that to central bank buying, and we've credited a good bit of that to domestic Chinese buying. And in that central buying component, a large part of that has been the People's Bank of China buying gold as well. That I think is undoubtedly a big part of the story. But if you look at what's driving the market, if we look at the traditional sources, we look at physical demand in the West, which should be growing as the price rises, and it isn't. It's fairly stagnant. We look at GLD, the largest gold ETF, and its holdings are stagnant. In fact, during the early part of this rise, this very strong rally in gold, the holdings were dropping off a cliff. They were exiting the GLD, and so we weren't getting Western investor demand. Those are some of the primary sources that we can see. What isn't really visible to us are really two areas: central bank buying and the over-the-counter market for gold, the over-the-counter options market for gold. They're both very vague, hazy, very opaque, and we really don't have a good handle on what goes on there. I think those are two sources for this buying right now. It smells now to me that the price rising as it is, with a large degree of demonstrated indifference to all these other factors and to the very fact that the price is rising so strongly, speaks of desperation buying, longer term desperation buying, that somebody is stuck on the short side of the ledger and needs to buy gold. And that, I think, is happening to a large degree in the over-the-counter market. And I think to a large degree that gold, the physical metal, is being supplied by the gold ETFs. That the money, the gold coming out of those ETFs is going to fulfill these large short positions.
You answered that. I actually just added in a question about 20 minutes ago, and we're going to get to that in a second, because like literally you just started to answer that question exactly. But I want to kind of just back up a little bit, because I think that's going to be a very interesting part of this conversation. I was watching your recent speech at the Metals Investor Forum earlier this year called Gold in 2024, Pivot Postponed. You spoke about federal debt. You just did a moment ago. You shared a very interesting chart of the federal funds rate versus the gross federal debt from back in Paul Volcker's day to present, which essentially showed what you just said: lower interest rates, understandably leading to vastly increased debt load. You followed that with a chart showing federal debt versus the interest expense on that debt that is obviously skyrocketed in this high interest rate environment. So that leaves us with the conundrum that the Fed has right now. It's keep rates high or potentially increase them in order to get inflation cooled off at the expense of having even greater debt expense that they have to pay off. It's like, they're damned if they do, damned if they don't. What's the solution here? And just to add to that, actually, I read something yesterday. It was Jamie Dimon's letter to JP Morgan shareholders, where he mentioned that interest rates could rise to anywhere close to 8% in order to cool inflation. I don't know if you've had a chance to read that, but I'm curious what your thoughts are on that as well.
Well, a lot of these pundits are ignoring the elephant in the room. Yeah, you can raise interest rates, but then what happens to debt service costs? Yeah, you can kill off inflation if you send the economy into a very deep recession or even a depression, because, well, 20% of the large companies in the U.S. were zombie companies that were barely able to pay the interest on their debt loads when interest rates were near zero, or the Fed funds rate was at zero, and they were barely surviving. When all of that debt resets over literally the months to come, those companies are going to, they're going to be killed like the zombies you see in all of the television shows. They're going to be beheaded in front of our eyes. And so, yeah, that's what higher interest rates, or even interest rates at these levels, are going to do. That probably will kill off inflation, and Jamie Dimon is correct, but he isn't telling you the other side of the story, which at this point isn't speculation. It's not even extrapolation. It's simple math. The U.S. economy cannot endure rates at these levels, given the debt loads that we already have. The U.S. itself is in a debt spiral. You talk about, we're talking about $1.5 trillion deficit every year. What that means, because there's a few $100 billion of off-budget expenditures that aren't included in the deficit, that nonetheless add to the debt. We're talking about adding $2 trillion to the federal debt at the current run rate every year. Well, then you add another $1 trillion in just the cost to service that debt, and that number is rising. So where are they getting that money? Well, they're borrowing money to pay the interest on the debt they already owe. That is a classic debt spiral. And yes, we are, the US is the issuer of the world's reserve currency. But even so, at some point, deficits matter, deficit spirals, spiraling deficit spirals matter, even for the issuer of the world's reserve currency. So we are getting to that point. And to a large degree, I think that realization, which you won't hear about on CNBC, you won't hear about from Jamie Dimon. I think there's smart money, big money around the world that is understanding this dynamic in effect in front of us, and that's one of the reasons why they're buying gold. I do think there's something structural going on in the gold market, long-standing imbalances on a supply standpoint, and imbalances of gold supposedly being in one place, but actually not being in that place, meaning primarily national gold reserves. I I think that's coming into play now too, because the kind of demand we're seeing now, the kind of demand and buying that we're seeing, the kind of price action we're seeing, speaks of hundreds of tons of gold that are desperately being bought around the world right now for some reason by someone.
Yeah, it's very interesting. And the first thing I thought when I read Jamie Dimon saying that was it took me back to Jay Powell. This was a month or so back, talking about regional banks and saying that, some of them may have to either fail or be merged out of existence by the bigger banks. And I'm sitting there thinking, well, this is Jamie Dimon getting ready to start buying up some assets on the cheap. So it'll be interesting to see how that all plays out. And yeah, just his words kind of caught me a little bit by surprise yesterday. Now let's get to, as I just said, I added this question in a short moment ago, and you touched on it a bit. We're talking about the Western gold market. I was reading a Twitter thread earlier today about gold's current run, headed by central bank and Chinese buying. The thread posed the question about the Western gold market, which you said is obviously soft. And it discussed whether or not that market had been heavily manipulated over the recent years, and if that manipulation is now coming to an end. I want to get your thoughts on this. I'll set the table a little bit here about what the thread was discussing, but it was talking about how in recent years, obviously discussions around transparency of markets and the fairness of financial markets has been front and center. The question kind of looked into different aspects, including the role of central banks, large institutions, over-the-counter trades, and the potential for price suppression or inflation through the futures markets, over-the-counter trading, paper gold. I saw a stat that in the paper gold market, 300 to 1 of those trades settle in cash. So you're not taking physical ownership of the underlying asset, which leaves a little bit of ambiguity, a little bit of room for manipulation. How do these entities influence that market? Do you think there's manipulation going on in the gold market? And are we now seeing that start to unwind?
Yeah, I've never been one to think that there's manipulation to the extent as some do believe on a daily basis. I don't think the government is that efficient, frankly, or that capable of executing some kind of an operation like that. That said, the commodity markets, the futures and options markets are structured in a way that you can manipulate the price of just about anything for profit reasons. And that is done. That is done on a regular basis by people who have very quick computers, great bandwidth, good algorithms, and have a lot of money to put at work, driving a market in one direction and then driving it back if they so desire. So I think some of the gold and silver markets have been manipulated, but I think they have been in the futures and the paper gold and silver markets as they would be for a lot of other markets. Gold and silver are really kind of Goldilocks. They're of the right size that they can be moved, but still large enough to provide the kind of profits that these entities want. All that said, there has been manipulation by governments and the US government in history. And I think that still happens at key points. I think the burden of proof really is on someone to prove that there isn't manipulation, because the US government has done overtly and covertly in the past, and there's no reason to think that they wouldn't do it at key points in the future. And given the price moves we've seen, I think they would be motivated to do that at some point, because it's not reflecting very well on the current monetary, the policies of the current monetary regime. So I think that's part of it. Now, one of the things I've been thinking about very recently, as we stand in awe of this move in gold and try to find out what's really going on, is research that we helped facilitate back in the the mid to late 1990s by a guy named Frank Venerosa. We published something called the Gold Book, which was a seminal work, and in Frank's research into the topic of essentially how central banks have been loaning out or had been loaning out their gold reserves to bullion banks, who then immediately sold it in the market. This was one of the factors driving the price of gold back down relentlessly through the 1990s. And so the central banks on their books held the gold, or said they held the gold, but in fact, all they held were IOUs from these bullion banks. So there was a tremendous dislocation there. You add up other evidence over the years, like Germany trying to get its gold repatriated, and the U.S. Treasury saying, "Well, that's fine. We'll give it to you over 7 years because it's going to take that long to mobilize it." And that's an obvious admission that the gold isn't there. So there are issues that I think are still existing, that gold isn't where it's supposed to be in the world, and is trying to get back in its proper place before the curtain gets pulled. And some people don't have that gold to put there. So I think a lot of IOUs are being called. I think there's gold being bought with a tinge of desperation to it right now. And the good news for us being involved in the market is all of this is occurring before the big factor that we touched on earlier that we've been waiting for has even come to have any effect, and that's the Fed pivot, which again is inevitable at some point. That pivot is going to come probably at a point of desperation without inflation being brought down to its target. It's a hell of a picture right now for gold and for gold investors. It really is.
That's a fantastic answer, and I'm glad that you touched on the central banks selling to the bullion banks, because that actually comprised a pretty big part of that Twitter thread that I was reading. So that was perfect. It's almost akin to naked short selling in a form or fashion. So yeah, it's interesting to understand what's kind of at play here. And I think you hit the nail on the head, is that they're trying to make sure that the gold is being bought back where and go where it needs to go, in the event that something bigger happens. I want to pivot. You mentioned silver a little bit. I know you're obviously, tapped into the mining sector as well. Obviously, both silver and miners, investors have been waiting patiently. They've been getting beaten down. Silver's been on a nice little run in the last couple of weeks following gold, but everyone kind of has bigger targets for both silver and miners. What are your thoughts on both of those spaces right now?
Yeah, it's largely a lot of it's perception, and after we had you can take this gold run as we stand now. It began really the last day of February. Gold went up $10 that day, and then went up, I think, $40 the first of March. And saying that really is when this run started. So we're looking at, as we speak, about 6 weeks of this gold rally, and you can divide that, I think, into 3 2-week sections. The first 2 weeks, we didn't think that silver was leveraging the move. We didn't think largely that the mining stocks were leveraging the move, and I kind of debunked that at the time. Came out with the charts that showed actually the gold silver ratio was falling. The mining stocks had actually been providing leverage, and but it was a matter of perception. We thought they would be doing more, so we didn't think they were doing anything at all. but they were leveraging to some extent. The next 2 weeks, the midsection of this rally so far, silver fell off and did not outperform gold. The mining stocks continued to outperform gold, but the perception was still there that they really weren't, because a lot of the people we talked to are involved in the junior sector, and it hadn't quite gone down the food chain to the juniors yet, and frankly still hasn't. But the big miners did leverage the move, and they have throughout all this. In this last third, the miners have still leveraged or outperformed gold generally, although we believe they should be doing more. But silver has really caught fire. And that's a sign that we're getting the speculative interest, because central banks don't buy silver. And we're seeing the speculative interest come in. India has come in because India is tremendously price sensitive. They do not buy, or have not bought in the past, on a gold uptrend, and they like to be bargain hunters. Well, now by bargain hunting, they see the uptrend in gold and they're buying silver. And India is very much culturally associated with gold buying and silver buying as a form of savings. And it is a monetary commodity in India. So we're seeing silver demand soar in India. And I think part of the speculative interest from Western investors, US investors, is being focused on silver. So it's a good sign. It's one of the things we look for to validate a move in gold. Is silver outperforming, or the mining stocks outperforming? And right now, both are doing so, and doing so significantly.
Awesome. Thank you for that. Listen, Brien, it's been a real pleasure to have you on the show. We're definitely going to do this again. Just in closing, obviously, we'd be remiss to not talk about the gold newsletter. If you can tell our audience what's in the newsletter, how they can subscribe, and how else they can follow along with you and your insight.
Yeah, Gold Newsletter is the longest running precious metals advisory in the world. We're in our 53rd year. And actually maybe the longest running investment newsletter in the world at this point. And we cover the macroeconomic factors moving the metals, and then we cover gold, silver, and other metals and resources. And we focus a lot on the junior mining sector with recommendations there across all of their commodities, and try to find investments that will make our readers a lot of money in a short period of time. We've been very successful at that, among the most successful out there, even in bear markets. And of course, in a market like this, you got to be involved. You can't sit on your hands in a market like this. There are too many opportunities for really tremendous wealth creation not to do that. We also produce the New Orleans Investment Conference every year, and it is the longest running investment conference in the world today. It is kind of a legendary event. We try to keep it that way. And this is our 50th anniversary for that this year. That's going to be held in November. You can go to goldnewsletter.com to learn more about Gold Newsletter, and neworleansconference.com to learn more about the conference.
Thank you, Brien. Listen, like I said, we're definitely going to do this again. We appreciate your time greatly.
Thank you so much for the opportunity.
Absolutely. Let's turn it over to Mark Yaxley. Bring him back in for his weekly Bullion Basics segment. Mark?
Thank you, Jeremy. In this week's Bullion Basics, I want to talk about profit taking. I've had a few of my longtime clients reach out to me over the last couple of days to discuss the possibility of liquidating some of their gold and silver, which they've now realized healthy gains on of 25% plus. These are people that have been buying gold and silver with us over the last 4 or 5 years and have realized some nice gains. And now they want to have the conversation about potentially selling some of that gold and silver at a profit. During those conversations, I can sense their hesitation in selling any of their beloved metal. It's served its purpose and it's done well for them. And as you know, many precious metal investors can be very loyal to their stacks of gold and silver. But I've been reminding them during these conversations that there is never harm in taking profit. It is, after all, the whole purpose of investing. And I also remind them that the climb to higher highs for gold and silver will not be a straight line. There will be pullbacks along the way, especially if broader markets begin to sell off. If we start to see continued sell-offs in the S&P, in the Dow, in the NASDAQ. Gold and silver will tend to fall as well as money starts moving around, and there will be opportunities for people to rebuy their gold and silver positions at lower price points. So there will be an opportunity for buybacks in the near future. And remember, if you're a client of SWP, you can always liquidate a portion of your metal, hold the cash with us, and then use that cash to repurchase metal at any date in the future. It's easy. And again, it never hurts to lock in profits and enjoy some of that free money. Thank you, Jeremy.
That is all for us today. Thank you so much again for watching, and to Brien Lundin of the Gold Newsletter for joining us today. Also, check out the Strategic Wealth Preservation YouTube channel for all the information you need to know on precious metals investing, or send us an email to info@swpcayman, and a member of our team will happily assist you. Until next week, stay safe and happy investing.
Thank you for listening to Inside the Vault, the podcast that opens the door to precious metals. We hope you learned something new and enjoyed the show. See you next time on Inside the Vault with SWP.